Howdy, Jacob here. Today we're looking at company 57 in our dividend yield screener. We're making some damage even though we're still on the E's. Evergy and company. So $11.9 billion market cap, $21.2 billion enterprise value. So enterprise value is almost double market cap. Good amount of net debt. 4.96% dividend yield. Let's go back to the debt quick. Long-term debt of 9.9 billion. It used to be 3 billion 10 years ago. So huge increase of debt. Looks like between 2017 and 2019, there were two large increases of debt. Let's see, 2017, 2019. Looks like a sell-off of a business. Wonder whether they increased debt there. But they also bought back a bunch of shares there. 2018, 2019. Looks like they increased shares. Okay, weird story going on. Capital expenditures. Ooh. Let's see. How's revenue been going? All right. All right. So similar business to um, Duke Energy, except at least they have produced free cash flow in the last 5 years. So looks like this is a company that's investing for growth, and you can definitely see that on the revenue side, 2.4 billion all the way up to 5.8 billion. However, due to all that growth, the property, plant, and equipment is your capital expenditures, which is essentially just to upkeep the business. And maybe there's also increased costs for um, other property and plant that'll increase business, but it looks like it's outgrown their cash from operations. And so it looks like they were pretty much flat over here, um, both almost the same. And then now, uh, at least in the last 2 years, the capital expenditures have outgrown their cash from operations. So they don't produce positive free cash flow. Looks like there was a 4 year period between 2017 and 2020 where they produced 400 million. What do we have here? 150 million almost, a little over 400 million, 530 million, and then not even 200 million. And they are currently paying out 563 million in dividends. So that is the reason that their debt has just consistently gone up from 2019 to today, is because they're paying out a dividend that they cannot afford. So I think our dividend assumption is going to be cut by 10, which would have a 50 million payout. I mean, I'll be generous. Just cut it 80%. That'll have them pay out about 110 million, which, I mean, if you look at the last 2 years, is nothing, but I guess they can afford that sporadically. But now they have a lot of debt, not a lot of cash on hand, just 25 million cash on hand. So yeah, that's my assumption there. And then the actual appreciation side, I mean, it's a growing company. They have definitely grown the business. I might assume five, and then um, I'll just do 13 here because the business return on invested capital is next to nothing. So although they can grow the business, we're seeing capital expenditures increase faster than their cash from operations, which not some I really want to see. As for margins, 13, 5. I mean, let's assume 12%, and then they haven't produced it the last 2 years. Maybe they have some sort of free cash flow margin, and then assume no share change. Yeah, it's gonna look ugly here. It's gonna say needs to drop 73% from its current price to get us to a price that will give us 15% return based on these assumptions. And this is a dividend yield screener. We want companies that are going to give us 4% or greater on their dividend yield. And I think that as they don't produce free cash flow, they are going to have to cut this dividend out, as its payout is well above what their free cash flow is. So for right now, not doing anything, and I'm going to the next company. So thanks. Have a good rest of your day.